Good morning, ladies and gentlemen. First of all, we would like to offer a warm welcome to all of you who have joined us today for our 2025 first half result presentations. As usual, we will follow the traditional format given in our events. We are going to begin with an overview of the results and the main developments during the period, and additionally, and on this occasion only, we will provide details of the equity rise currently underway. Everything done by our top executive team that is today with us, Mr. Ignacio Galán, Executive Chairman, Mr. Pedro Azagra, CEO, and finally, Mr. Pepe Sainz, CFO. Following this, we'll move on to the Q&A session. I would also like to highlight that we are only going to take questions submitted via the web, so please ask your question only through our webpage www.iberdrola.com. As mentioned previously, in today's event, we will be discussing, in addition to the H 2025 result, certain information regarding a proposed capital market transaction, access to which is restricted for persons located in the United States of America. Accordingly, persons located in the US will be unable to log in at this time, and if any such persons have logged in here, we would kindly ask them to please log out. Finally, we expect that our event will not last more than 75 minutes. If any question remain unanswered, we at IR Department are, as always, fully at your disposal. Hoping that this presentation will be useful and informative for all of you, now, without further ado, I would like to give the floor to Mr. Ignacio Galán. Thank you very much again. Please, Mr. Galán.
Thank you, Ignacio. Good morning, buenos días, everyone, and thank you very much for joining this call. Today, as usual, we'll present our result, and we will give you also all details of the equity rise announced this morning, which I can already inform to you that now is fully oversubscribed in this particular moment. In the first half of 2025, net profit reached 3,562 million euros, up 20% year-on-year, excluding the capital gains from the last year divestment of thermal generation asset. And the reported EBITDA was 8,287 million, driven by a strong performance in our networks business, with a 31% increase in EBITDA in the first half of 2025. EBITDA from production and customers was impacted by lower prices and one-off system costs in Iberia, particularly offset by the contribution from new asset in operation and the recovery of production in the second quarter compared with the first 3 months of the year. Investment rose by 7%, reaching 5,662 million in 6 months, driven by a 14% increase in networks investment to 3,082 million. Also, we expect this upgrade trend to accelerate in the coming quarters thanks to the new regulatory frameworks and the negotiation. They show significant increases in investment. Up in the case of UK's 14 billion euros following the RIIO-T3 draft determination, and 15 billion additional in transmission and distribution according to the rate filings made by Avangrid subsidiaries in New York and the expected increase in the common rate case in Maine. Renewable investment reached 2,152 million, in line with the first half of the last year, with 40% of the total invested in our offshore wind project under construction. All of them, I can already confirm, are progressing under schedule and budget. We have also continued making progress in our asset rotation and partnership plan. In last weeks, we expanded our partnership with Masdar with an agreement to co-invest in Isangre 3 offshore wind farm in UK, which combined with Baltic Eagle takes a total co-investment to almost 7 billion euros. And we have also closed other asset rotation transactions worth 1.5 billion euros, on which 1.3 billion will be cashed during the second half of the year. This, together with our strong cash flow generation up to 15%, has led a reduction of 3 billion euros in our consolidated net debt in the second quarter, which now stands at 52.7 billion euros, and to a strong improvement in our FFO to net debt ratio, already above 24%. Now, moving to the 5 billion euros equity rise announced earlier today, the recent progress in our regulatory framework in US and UK has materialized an unprecedented investment opportunity to accelerate our growth that is fully coherent with our strategic focus in regulated networks in 8 countries with stable and attractive regulatory frameworks. The draft determination published by Ofgem Rio T3 and the rate case filed by Avangrid subsidiaries in New York will imply investment of around 30 billion euros, leading to total network investment of 55 billion euros up to 2031, 75 more than the previous 6 years. And the group total gross investment, including power, will increase to around 15 billion euros per annum compared to the 11 or 12 in the last years. This new long-term stable framework in the UK and US also offer attractive return, driving an expected average regulatory return on equity of 9.5% up to 2031, and making the transaction accretive on EPS thanks to the contribution of those additional profitable investments. The equity rise, together with our ongoing financial sources, operating cash flow, access to debt market, liquidity, and our asset rotation and partnership plan, will be sufficient to fully fund our investment plan with no expected additional equity needs, at least until 2030. All in all, this transaction allows us to take advantage of unique investment opportunity to grow faster and take a major step in our strategy focus on networks in the US and the UK. Moving back to our first half result, as mentioned, EBITDA reached 8,287 million, driven by 31% growth in networks, thanks to the positive impact of the investment on our regulated asset base in all countries. The full integration of Electricity Northwest and the strong result in the United States, which include the recognition of past costs as explained last quarter. This positive performance in networks more than offset the evolution of production and customers, which had a 13% decrease in EBITDA, due to lower prices and non-recurrent impact of one-off cost of more than 135 million euros in the Iberian Peninsula related to higher ancillary service requested by the system operator to reinforce the power system after blackout suffered in May. We expect this impact to reduce in the second half as contracts with our customers are rollover reflecting this cost. These two effects were partially offset by additional production from the 2,000 megawatt put in service in the last 12 months, and the recovery of production in the second quarter after a very low beginning of the year, especially in the United Kingdom. By region, 82% of our EBITDA comes from rate countries, with the United Kingdom and US accounting for close to 50% of the total. Investment grew by 7% year-on-year to 5,662 million euros, mainly due to the strong expansion in networks up to 14%, reaching close to 3.5 billion euros, 65% in distribution, 35% in transmission. By region, the United States and the United Kingdom represent 2/3 of the total. Transmission and distribution investment in the United States exceed 1 billion euros, with 2/3 in distribution, mostly New York. And the investment in the United Kingdom also reached 1 billion, with 60% in distribution, including Electricity Northwest, and 40% in transmission, driven by Rio ED2 and Rio T2 frameworks. This investment have resulted in total regulated asset base of close to 50 billion euros, 70% more than just 5 years ago. And we expect to continue accelerating growth until the end of the decade to reach more than 90 billion euros by 2031, multiplying our network asset base by 3 times in just 1 decade. With around 35 billion euros in the UK and 30 billion euros in the US, for a total combined contribution of these two countries of 75% of our total RAP. This unprecedented increase is driven by energy policies across our regions that are reinforcing and expanding power networks, with the objective of increasing energy security and autonomy and improving competitiveness. Like the National Policy Statement for Electricity Networks Infrastructure in the UK, recently published, which has improved clarity and efficiency in planning processes. In the US, a national transmission planning process has been designed by the Department of Energy to modernize and expand the electricity transmission system. And in Brazil, the renewal of distribution concession will provide long-term visibility to investment. And finally, the European Commission recently published its guidance on electricity grids fit for the future, urging member states to develop policies to attract 730 billion euros of investment that will be required just for distribution by 2040. Like the elimination of investment caps or delays in the recognition of investment made, and the implementation of a system capable of attracting those massive new investment. Following these policies, most regulators are approving a stable and predictable framework with a strong increase in investment and the right incentives. In the United Kingdom, we expect our investment to reach €26 billion from 2026 to 2031, 4 times more than the last 6 years, following the draft determination published by Ofgem for RIIO-T3 in transmission and the strong increase in distribution expected until 2028 under RIIO-ED2, already approved, and RIIO-ED3 from 2028 onwards. In transmission, the RIIO-T3 draft determination recently published shows that Ofgem is moving in the direction to promote investment by increasing cash generation, improving returns on equity, and introducing inflation protection measures. We expect final determination by year-end once we finalize the ongoing negotiation. Our investment in the United States are expected to almost double in the next 6 years, reaching €20 billion, mainly driven by a large increase in New York, where our rate case negotiations are also making positive progress. In the case of Brazil, we expect the renewal of distribution concession for 30 years will be completed in Q3, creating the right framework to increase investment in these businesses. While in transmission, we do not anticipate new investment once the project already under construction are finished. Finally, in Spain, we are expecting the investment are clearly lower than in the other 3 regions. We expect the initial terms proposed by the regulator will be improved along the process. Moving to renewables, investment remained flat in the first half, €2,155 million, as high investment in offshore wind offset the decrease in onshore, especially solar PV in Spain. By region, 60% of the total investment were made in the United Kingdom and the United States, where we expect no impact from the new federal budget legislation, as it does not affect the 1,100 megawatts we have under construction or the additional pipeline onshore wind and solar PV that are ready to be operational before 2029 that could qualify for tax credit under current guidance. Also, New England one offshore wind farm will continue to qualify for tax credit if it's in operation before 2023, if we decide to go ahead with the construction. Offshore wind investment reached €150 million in the first half, and all our projects under construction are progressing as planned, with their revenues and supply chains already secure. In the US, more than 1/3 of Vineyard Wind 1 turbines are already installed, with more than 25% of them already exporting energy. In the UK, our 2 offshore wind projects under construction, with a total capacity of almost 2,400 megawatts, continue advancing as scheduled. East Anglia 3 is expected to be fully operational by 2026 year-end, and the works of East Anglia 2 are progressing. Additionally, East Anglia 1 North project, with 900 megawatts of capacity, has already secured its permits and could participate in the coming ER7 auction. As you know, the UK government recently announced an extension of contracts for difference from 15 to 20 years for the new auction. Finally, in Germany, the construction of Windacker of 350 megawatts is ongoing, with a COD expected by 2026. And we recently commissioned Baltic Eagle with 476 megawatts, the first investment included in our strategic alliance with Masdar. As was recently expanded to co-invest in the East Anglia 3 wind farm in the UK with 1,500 megawatt capacity in a deal value of €5.2 billion, driving our total co-investment with Masdar to almost €7 billion between these 2 projects. The East Anglia 3 transaction allows us to reduce our consolidated net debt by €2.5 billion as well. In the last several months, we also signed a co-investment agreement with Kansai for the Windacker offshore wind farm in Germany, with a total investment of €1.3 billion. In addition, our €2.4 billion partnership with Norges Bank for renewables in Iberia is also progressing as scheduled, with 1,100 megawatts under construction. And finally, Brazil, our agreement with GIC for transmission asset has already delivered €150 million in co-investment. Over the first half of the year, we also closed asset rotation deals worth €1.5 billion, such as the divestment in Baixo Iguaçu hydro project in Brazil, with €200 million already cashed in, and other transactions like smart metering business in the UK, United Kingdom, and Avangrid Grand Distribution asset in Maine, that all in all will allow us to receive 1.3 billion euros in the second half of 2025. Moving to operational and cash flow, our FFO increased by 15%, reaching 6,796 million euros, driven by higher cash flow in our networks business in the US and the UK. This strong cash generation, together with the asset rotation and partnership, has led to a reduction of 3 billion euros in our consolidated net debt to 52.7 billion, and to stronger financial ratios, with FFO for consolidated net debt improving by 190 basis points up to 24.2%, even after the full consolidation of 2.2 billion euros of debt from Electricity Northwest. Finally, as you know, following the approval of our total dividend of 0.645 euros per share in our AGM, tomorrow we will pay a supplementary dividend of 0.409 euros on top of the dividend paid in February of 0.231 euros, and the engagement dividend of 0.005 euros per share paid in June. Now, let me give you some more detail of the transaction announced today. The unprecedented investment in network infrastructure in UK and US, explained earlier, constitute a unique opportunity to accelerate our growth. This 75% increase in investment expected in the next 5 years will allow us to reach a regulated asset base of 90 billion euros by 2031, multiplying its size by 3 times in 1 decade, and increasing the combined weight of our US and UK up to 75% of the RAP, with clear and stable framework delivering average expected return on equity of 9.5%. As a result of this increase in networks investment, total group gross investment, including power and others, will reach around 15 billion euros per annum in the coming years compared to the current 11 to 12 billion. Taking a major step in our strategy to increase our focus on networks in the US and UK, improving our profitability in our risk profile. Financially, the transaction will have a positive impact on EPS, reinforcing our long-term outlook of mid to high single-digit growth in net profit. In addition, the amount of this equity rise, together with our other ordinary financial sources, including operational cash flow generation, ongoing access to debt market and liquidity, and our asset rotation and partnership strategy, will allow us to fully fund our plan without any further need to increase share capital, expected at least until 2030, preserving our rating and our current dividend policy, and therefore strengthening our value proposition of growth, dividend, and financial strength. I will now hand over our CFO, Pepe Said, who will present the group financial results in detail. Thank you.
Thank you, Chairman, and good morning to everybody. So let's go through the results. The first half net income reached 3.5 billion euros and grew 20% once compared with the first half of last year adjusted net income, underpinning, as the Chairman has said, the underlying growth of the business. As main change of perimeter, let me remind you that ENW is fully consolidated since March of this year. FX evolution has had a minor effect on results thanks to our FX hedging policy, with the dollar being 0.5% lower, the pound 1.8% higher, and the real 13% lower. A 0.5% increase in revenues due to the network business, combined to a 1% decrease in procurements, drove a rise in gross margin of 1.6% to 12.7 billion euros. Excluding the 1.7 billion thermal generation asset divestment in the first quarter of 2024, the first half results net operating expenses improved 9.8%, mainly due to 300 million lower storm costs that are also diminished at gross margin. Net personal expenses fell 2.3%, including a net positive 24 million pension adjustment, and external services fell 8% due to lower storm costs. Other operating income grew 29% versus the first half of 2024, adjusted, as I mentioned before. Due to the indemnities of past year cost, ENW consolidation, all of them partially offset by an 81 million negative impact of the East of Anglia 3 deconsolidation. Excluding also the mentioned storm reconsolidation impacts and other impacts, net operating expenses improved 0.5%. Analyzing the results of the different businesses and starting by networks, its EBITDA grew 31% to 4.3 billion euros, mainly driven by better performance in the UK and in the US. In the US, EBITDA reached $1,547 million, or 129% up, with higher rates in distribution and better contribution in transmission, and positively impacted by the decision from the New York regulator that allows us to register under IFRS regulatory assets regarding past costs already accrued and registered under US GAAP, aligning both standards. In the UK, EBITDA increased 23%, reaching £745 million, including 4 months positive ENW contribution up to £150 million, and better contribution both in distribution and transmission. In Brazil, EBITDA increased 9.6% to 6,755 million reals, thanks to higher inflation over a higher asset base and a positive contribution from transmission lines as construction progresses. From April onwards, rate increases in Coelba, Pernambuco and Coser improved second quarter EBITDA and will continue to do so during the second half. In Spain, EBITDA increased 9.5%, reaching 892 million euros, positively affected by adjustments to past year's remuneration following court decisions. The first half energy production and customer business EBITDA reached 4 billion euros compared to 4.6 billion in 24, excluding the already mentioned 1.7 billion thermal divestment capital gain. The business reached 88% emission-free generation. In Iberia, the EBITDA was 1,960 million euros, 21% down, with higher production partially offsetting margin normalization. There are 110 million higher ancillary services costs, mainly linked to the reinforced operation of the transmission system operator Red Eléctrica, and 136 million higher levies despite 1.2% revenue tax termination. Record hydro reserves, 9 terawatt, will help the performance in the second half of the year. In the US, EBITDA increased 5.4% to $508 million, with better wind and solar performance, and despite the fact that the first half of 24 was positively impacted by the Arctic blast storm, one-off, and there has been during the last quarter lower thermal generation due to maintenance. In the UK, EBITDA fell 18% to £691 million due to lower EBITDA from the supply business driven by prices and volumes. Also, an 11% lower wind resource and lower prices, partially compensated by the recovery from last year's offshore operating problems and lower wind tax, contributed to this fall. Net operating expenses, including £68 million, equivalent to the 81 million euros I commented previously. Negative one-off impact linked to the East of Anglia 3 reclassification as held for sale. More than compensated this 81 million or 68 million pounds, more than compensated at the net financial result accounts. In the rest of the world, EBITDA grew 31% to 411 million euros, with 68% higher offshore production due to the full entry in operation of Saarbrück in France and Baltic Eagle in Germany offshore wind farms, while the supply business lowered its contribution mainly due to the 25 million negative impact in Portugal due to the, again, ancillary services costs, mainly as a consequence of the blackout. In Brazil, EBITDA decreased 31% to 564 million reais, with lower thermal contribution compared to a strong first half of last year. Finally, in Mexico, EBITDA reached $278 million, 87 lower contribution compared with the first half of 24, that included the thermal assets capital gain in the first quarter, and 42% excluding it, as the remaining business had a higher availability and a better balance in revenues. Depreciation and amortization and provisions are up 2% to 2,820 million euros, driven by higher asset base, partially compensated by lower depreciation thanks to the full year 24 adjustments, mainly in the US onshore, and also due to lower bad debt provisions in all geographies, but especially in Spain and the UK. EBIT reached 5.5 billion euros and grew 6% on an adjusted terms. The net financial result improved 183 million, from 848 million to 665 million euros, thanks to a 292 million positive impact from the East of Anglia TRIP derivatives as a consequence of the consolidation of the asset. Other derivatives, mainly linked to the P&L hedges, had a 69 million positive impact. Debt-related costs grew 157 million due to the higher average net debt, while interest-related costs improved by 48 million due to a better cost of debt, as you can see in the slide, that decreases 19 basis points, mainly thanks to lower short-term interest rates, especially with the euro and the pound, and to the depreciation, especially of the real, despite higher interest rates in Brazil. Net debt reached 52.7 billion euros, improving from the 55.7 billion peak at the end of March, and increasing only 1 billion from December 24 closing. This positive evolution was driven by a 6.8 billion FFO, plus 3 billion asset rotation and debt consolidation that covered the 5.7 billion capex, 2.3 billion dividend, and ENW net debt consolidation. Net debt evolution, together with a 15% growth in FFO, drove credit metrics to be comfortable within rating agencies' thresholds for BBB, Baa1. FFO adjusted net debt reached 24.2%, improving versus 22.9% December closing, and our adjusted net debt to EBITDA reached 3.3 times. Our adjusted leverage ratio was 46.8%. In the first 6 months of the year, Iberdrola has signed 11.4 billion of new financing, completing some very important transactions like the East of Anglia TRIP project finance for £3.6 billion, the recently signed sustainable 2.5 billion credit line, the first green senior bond fulfilling EU, GBS and ICMA standards, and being the first European company to be financed by the National Wealth Bank. We have also get financed from the European investment banks based on the next generation funds, where we have obtained in all of these transactions benchmark conditions, and we continue leading the green and sustainable financial markets. Net profit grew 20% to 3,562 million on an adjusted terms, compared to the 2,969 million adjusted first half 24 net profit. And now the chairman will conclude the presentation. Thank you very much.
Thank you, Pepe. As you have seen, our first half results show a strong operating performance that we expect to improve even further over the rest of the year. With networks as the key growth driver, thanks to double-digit increase in our regulated asset base, mainly US and UK, reaching more than 51 billion euros altogether. And on top of this, we will benefit from the new rate cases closed in the first half, mainly United States and Brazil, and the positive impact in the full integration of electricity in the West. In production and customer, we expect higher production in the second half of the year, driven by the 2,000 megawatts added in the last 12 months, plus 1,400 megawatts more than we expect to put in operation before the year end, as well as by higher wind resource expected in the UK, where wind conditions in the first quarter were one of the worst in the last 25 years. We have also signed a new PPAs for almost 5 terawatt-hours per annum in the last 12 months. They will deliver revenue certain at the attractive prices for the future. And our hydro reserves remain at record levels of around 9 terawatt-hours, allowing us to expect even new record in pump storage, hydro pump storage at the moment with strong spreads. This positive business outlook, together with our ongoing financial strength, leads us to reaffirm today our 2025 net profit guidance of double-digit growth or mid to high single-digit growth, excluding the recognition of the past costs of the networks business in the United States. To conclude, the equity rise launched today provides us further visibility and security in our long-term growth outlook and give us a unique opportunity to accelerate our growth fully in line with our strategy focus on networks in the US and the UK, reinforcing our value proposition based on strong growth, sustained dividend increases, and financial strength. We will give you more information about our future outlook for the coming years in our Capital Market Day, will be held in London September 24. I hope to see you all there this day. Thank you very much for attending this call and for the trust you always place in us. Now we will answer you all the questions you may have. Thank you.
Okay, starting with the Q&A session, the following financial professionals are asking us questions today. Fernando Lafuente, Alantra, Gonzalo Sánchez Bordona, UBS, Ahmed Farfan, Jefferies, Pedro Alves, CaixaBank, Rob Pulain, Morgan Stanley, Fernando García, Royal Bank of Canada, Jorge Guimarães, JB Capital Markets, Daniel Rodríguez, Bestinver, James Brandt, Deutsche Bank, Javier Suárez, Mediobanca, Andrew Mulder, Credit Suisse, and Jorge Alonso, Societe Generale. The first question, the first group of questions are related to the capital rise deal. First one is the main question analysts are asking is related to the rationale of the equity rise. Why do you think the equity rise is a preferred option versus other means of financing?
Well, I think we have an extraordinary and unprecedented opportunity to invest in networks. I think it's not new for us. Then we said already in our CMA that our priority is investment in networks, and we will prioritize networks and will be selective in renewables. And I think we were expecting that the network business, the networks demand increases in most countries, but we are not expecting to increase as soon as it's increasing in the size which is already being produced. I think once we got already the confirmation of the numbers from the UK regulator, and once we have already started conversation with the American regulator, so we saw that what is the size of the investment we have to afford in the next few years, and we feel that that is the best solution. Why? Because I think it's a sector which is clear, stable, and attractive frameworks. We are investing in A-rate countries that need this huge investment. But I think that is regulated, and regulated means they require a minimum equity requirements. I think there are limitations to finance only with debt. If we would like to maximize the return, I think the debt is paid by the regulator and the equity is paid in different terms. So that's why I think we feel it's better to make equity instead to put already debt, because I think that will be not good for the shareholders. Apart of this one, for the rest of our investment, we will continue to be financed with our operating cash flow, where you saw the needs increasing by 15% in the first half. With our liquidity, we have more than 20 billion. And with the asset rotation and partnership, we will continue. I think we have already signed very many during the first half of the year. You saw already, I presented already. But I think what is clear is with this opportunity, we are going to accelerate our growth. It's absolutely in line with our strategy. I insist that our priority was network in A-rate countries with attractive reserve frameworks. And with this increase in share capital, we are preserving our BBB+ rating. And we are keeping and maintaining our dividend policy which as we have already done in the last 25 years since I'm in the company. So we feel that is the best opportunity for shareholders making that one in this manner, instead to make in the form of debt, which I think in form of debt will not generate the positive returns then that can already be obtained if we inject equity in these opportunities. Well, it's clearly, I think, has no sense. If we have priorities networks, it's no sense to sell networks to invest in networks. So I think it's clear that our priorities networks, and we would like to keep networks, not to sell networks to invest in networks. So it's no sense. So I think we would like to be coherent with our strategy. Priority is networks, and we would like to increase our networks. I think to give you some numbers, I think in 2020 we have 30 billion euros RAB. Today is around 51 billion. In 2030 will be 90 billion. If you have an average of equity debt ratio in this RAB, that means we will be paying on the range of 45 to 50 billion equity at 9.5. That generates already just a net profit of the company in these regulated activities on the range of close to 5 billion euros per annum. That is the size of the company we are in this moment creating. So, and that is that is unique opportunity. And that's why I think has been such a huge demand of investors that they would like to participate in that one. That we are very pleased, because we are working for investors, and I think it will make investors happy, and that is an opportunity for investors to be even more happy.
Okay, before following with the question number 2, we have had two more analysts, Dominic Nash from Barclays and Philippe Orpatian from Nodo, and obviously, I'm sorry for that, Jorge Alonso belongs Bernstein, not SocGen, as I said. Second question, how much buffer financial flexibility are you trying to obtain with this capital increase? Can you give guidance about what do you expect in terms of leverage metrics over the next 5 years?
So we are fully confident that this transaction is more than sufficient to fund our extraordinary investment opportunities in the UK and US. I think it's, as I was saying, it's 75% more investment in this 6 years toward the previous 6 years. But I think this transaction will come together with another sources of financing. I think we are generating additional cash flow. So I think we are seeing that our cash flow in the first half is increasing by 50%. So I also will increase more thanks to the new investment, which I think the regulated is already generating cash flow from the very beginning. Liquidity as well, we have more than 20 billion liquidity. Recently we signed another lines of liquidity of 25 billion, Pepe, no?
Yeah.
Yeah, yes. 2.5 billion, and we have more than 20 billion liquidity. And I think we have plenty access to the debt. So I think I know bankers knocking our door all the time for giving more money, and we have easy access to the bond market. And I think Pepe will explain, has already explained clearly. And also we'll continue with our rotation. And those things we consider are not already a strategy for us, or we continue making partnership. I think only with Masdar we have partnership for 7 billion euros. With Norges is 2.4 billion euros, and with others, I think with Kansai we are 1.2, and others, and we continue on this. And I think with all those things we consider we have money enough to cover it and to fully to invest on this in this opportunity and preserve our ratios and preserve our dividend policy. It's very important on that one. I think for the 25 years in the company, I was already maintaining a very consistent and current dividend policy for shareholders. I think we committed with shareholders, the dividend is a must, and we are already just following these criteria in the 25 years. So that means we will keep already our financial solidity, may increase our growth or speed up our growth, and we keep our dividend policy. But nevertheless, I think that is the basis of our Capital Market Day on the 24th of September, then we can already present with more detail. But I insist on that one. I think it's a unique opportunity. And that is what today the shareholders or the investors are already asking for more and more, oversubscribing this opportunity.
Next is, given the recent changes in our management team, if this equity rise related to, in any form, to the naming of the new CEO, and given his past as M&A officer in Iberdrola, should we expect these proceeds to be allocated in a big M&A transaction?
So absolutely is not related. Pedro is a good guy. He has a lot of things to do for already looking for improvement of the business. He's fully committed with the company. He knows the company very well. And in the few days he's in the company, fully taking care of all those things which are related with the business. I think this rational transaction is nothing to see with himself. It's something which is rational, which is an opportunity what is appear, and I think and that this transaction, this opportunity of increasing the investment plan in networks in UK is just because the Rio T3 has been published. So it's as simple as that one. So it's not Pepe, it's not Pedro, it's not Juan, it's not Lope. It's just of GEM, we have already published a Rio T3, which is £14 billion investment, which I think is absolutely confirming our expectation, and that's why, for confirming this expectation, we are already just looking for this money. Same thing with United States. I think the New York rate case has been presented, negotiated with the regulator. Now it takes their time, but I think is aware they already accepted our proposal, and now we are in the negotiation how that can evolve. But I think certain those are the reasons, nothing to see with Pedro, which I'm delighted what he's doing and what he has to do. So, but that is nothing to see with himself for the moment.
Next is related to the asset rotation plan. Shall we conclude from your messages that you are not going to do any meaningful asset disposal?
So I think it's absolutely not. I think we will continue with our asset rotation. We'll continue with our partnership strategy. Last year, I think it's business as usual plus this extraordinary opportunity. That is the approach. I think this destination of this equity right is for organic growth, which means investment in transmission and distribution, mainly in UK and United States, for already providing and delivering the commitment we can take with the regulators. This equity rise is linked, I insist, in this extraordinary investment, and I think I insist, we hope it is sufficient to fully fund our plans together with another sources for ordinary investment, which I insist is the cash flow generated, the liquidity we have, the access on the market, and the asset rotation and partnerships that we will continue as we've been doing during the last few years. That is, this transaction is not triggering additional asset rotation and partnership on top of what we are expecting. I think it's business as usual plus this extraordinary opportunity. So I think if there any potential opportunity for investment arise, we will not expect the moment at all that additional asset, any rise equity again. We will make already with asset rotation as we did. I think if tomorrow we have to make any, let's say, a small opportunity, I think we'll make, as we have already done another one. I think we divest something for investing another thing, but I think we are not going to use this money for making already a new, let's say, acquisition. No, it's for that. It's for extraordinary investment in networks, mainly UK, United States, in the lines defined by Rio T3 and defined by the new rate case which we are underway in New York and in Maine.
Next, you have publicly stated that you now do not expect to need to come back to the market until at least 2030. Under which circumstances could this situation change?
So, please, I think we can foresee what we can foresee, and we have the picture of today, and with the picture of today, and with the situation of today, that is what we are foreseeing. In our commitment, you know, we are not already a company which changes our rules every night. So when we said something, we are committed and we deliver what we committed. So we are committed that with today's picture, knowing what we have today, we need money for an extraordinary thing. We've been for many years what we've been already maintaining our dividend policy, maintaining our investment policy, delivering our commitments, in our always ahead of our outlooks. That is our style, and I think now with the visibility we have already for the next 5 years, with this visibility, we don't need any other increase in share capital. So with our cash flow generation, with our liquidity, with our asset to the market, we are able to invest the visibility. We are going to present to you all these numbers on the 23rd of September. Enough resources for affording the visibility of the investment we have to afford in the next few years. Keeping and maintaining our dividend policy, keeping and maintaining our financial solidity as we did, and using our asset rotation if needed, and continue with our partnership as we have already done in the last months.
Next query is about other means of financing the plan. How much debt hybrid do you expect to raise over the next 5 years?
So I don't know the numbers, but I think what I think for us is very clear that our FFO net debt will be in line with our BBB plus rating, and that has increased in the size of the company. Also, if the size of them grows, the debt will grow. But I think we will preserve our strong ratios and we will maintain our dividend policy. In any case, I think we'll give more details on CMD. But I think you, Pepe, would like to add anything, but I think the data we will share with everybody on the 24th of September.
Yeah, absolutely right. I think the idea is to maintain this capital raise has been done to be under the BBB plus rating, which is we think that is the cost of capital lowest for us, and that is the idea. So obviously we have the numbers here, but I mean the message is that we will be in the BBB plus rating, well into this range, and that is what we are expecting. Obviously, we will raise a little bit the debt, but as the chairman was saying, we will also expect to raise the FFO, so the ratios will be comfortable between the BBB plus rating.
Next question is about dividend policy. I understand you are maintaining the dividend policy, but could you explain if your decision of issuing equity has been driven by the need to continue to pay an attractive dividend? By how much should you have cut your dividend to avoid the capital increase, just in case?
So I think I would like to insist again. That is an extraordinary opportunity. What we can already increase our RAP at nominal value instead of paying a premium of 40-50%, which is the normal transaction which is made in all transactional regulated activities. So, and for that, we would like then the shareholders benefit of this opportunity of in value increase of the company. So I think nothing to see with the dividend and nothing to see with the debt. The debt is decreasing, the dividend is increasing, and we would like to finance that one, maximizing the return for shareholders. If we increase the debt, that should be bad for shareholders because the debt will not be remunerated, will be only will be a pass-through. So the equity is going to be remunerated. The debt is a pass-through. So we put more debt in the regulated activity. It's good for banks. It's not good for shareholders.
Next, why is this capital increase accretive for Iberdrola shareholders?
You may, because it's accretive. I would like to insist. I think they pay the equity at 9.5, and the money is costing to us at 4%, between 9 and 4. So you see what is the return. It's very simple, but I think, Pepe, you can make the numbers. For me, it's very clear. The equity is paid at 9.5, and I think and the money is costing at 4.5. So the difference is accretive.
Yeah, well, that is what the chairman says. This allows us to invest an additional 5 billion in networks, as the chairman was saying, with an average return equity of 9.5%, and obviously that is accretive both in terms of net profit and in terms of EPS. Okay.
Last question related to the capital rise, although I think it has been already explained in the previous answer. Why do you think now is the right moment to raise equity? Why not wait until your next Capital Markets Day on September the 24th?
So I think we would like then the Capital Market Day will be we talk about business. We know how to finance the business. I think making that one, we can already just confirm then the way how we will finance is already fully solved. Also, it's because I think it's the object I mentioned before, the urgent draft determination was public a few days ago. And I think it's the time for saying, okay, how to make that one and to give already to a regulator the certainty that we have financial resources for affording the investment required. Same thing in the U.S. I think we just filing the new rate case, and I think the amount of money we are already presenting is such a huge, and the obvious question for regulator is, do you have money enough for funding this investment? And I think we can say now, yes, we have money enough, we have equity enough for funding either of yen and either UK, either in the United States. So, and I think that is already, I insist on that one, it's an unprecedented opportunity for accelerating our growth and delivering our strategy in networks, which is our priority, in two countries, which is clear, stable, well known for us. I think we are almost 20 years in both countries, attractive with predictable frameworks. I was recently with the British Prime Minister, and I think he was already explaining the policy related to electrification of the country and the measures they would like to make for making this country more attractive for attracting investment. And that is what we would like to already benefit of this opportunity.
Moving forward to the question related to the results, the first one is, could you please provide your view on the extension of the nuclear facilities, possible extension of the nuclear facilities in Spain?
So, I think nuclear plants, I think is, I said as engineer many times, I was repeating this for many times, are efficient, are safe. I think they provide autonomy and stability to the national energy system. And I insist is the most efficient solution to keep the lights on. And that's why I think all European countries are already extending, European and non-European, extending the life of this nuclear power plant. However, in the case of Spain, with the current taxation, with around 30 euros megawatt hour, which is compared with 15, is half with Spain and France, may then not viable with the forward prices we are expecting in the future. We was already what happened between 2010 and 2020. We are in a loss in our nuclear power plant. Why? Because a nuclear power plant are not already manageable. It's a price takers. So whatever price is set in the daily, I think we have to, we are paying on these terms. So that's why I think we cannot, as others, I think we can make an offer at the price another one, but in those ones we cannot stop and put in service. I think it's already working 24 hours a day. So that's why I think this base load system, which are not already, you cannot manage in the sense of others, like hydroelectric or like CCGTs of gas. That's why we are asking if that is the most efficient solution to keep the lights on. I think it's not at our cost. It's already, has to be already in a manner that we can already not be in a loss. And that's why we ask for a reduction of this tax burden. But I think even if this tax burden is already, let's say, flexibilized, I think some region, Valencia, is already flexibilizing that one, is already announcing this region to reduce this taxation. But I think even though, I think the existing legislation, if there are no changes, they don't allow us to ask for this extension. I think is needed changes in the actual legislation to allow us for asking for extension. We are not allowed to ask, but I think that I'm sure then that can be solved. But I think the point is the first and the second. First one, taxation, and second one, the government has to allow us to ask for the extension even after reduction of this taxation. I think in any case, what I can say for the Spanish citizens, so we are power enough in CCGTs in gas, more than double than that power we have already in nuclear, to provide the service. But they have to pay an extra price, as is already made already by the analysis of Pricewaterhouse, and we disclosed last time. They are expecting an increase of 35% extra cost for consumers if the nuclear power plants are closed. That is analysis made by PricewaterhouseCoopers, but which is confirmed as well by PricewaterhouseCoopers what is happening in Germany since they closed the nuclear power plant. The German consumers are paying more than those countries that are keeping the nuclear power plant in operation. So, but I think that is our proposal very clear. With the present taxation makes this power plant not economically not viable, even if they are absolutely the best, most efficient economical solution for keeping the lights on. But I think the lights on will be made with combined cycle of gas. Then we have double power than the nuclear. So I think the Spanish citizens can be sure then we can provide that one, but the cost will be much more expensive than keeping those one open. And that is the point. We have to be taking a decision. We are not making the energy policy. The energy policy is making by the governments, and the government has to decide. So we are already, if they like to close, we close. If they would like to keep open, we keep open, and we have the solution. But I think, nevertheless, I think we are in a continuous dialogue with them, but the thing is, the decision is not in our hands. It's in the hands of those ones who are making the energy policy, which is the government.
Next is related to the CNMC proposal for the next regulatory period in networks in Spain. Our opinion.
I can, to the same point, I start with the same comment. Energy policy is made by regulators and the government. So I think, and we have to adapt to these policies. I think it's clear the European Commission has provided very clear guidance how to incentivize the networks investment. And they said clearly the first thing they are talking is elimination of the investment caps. We have investment caps in Spain still. We need, that will say the European Commission, anticipatory investment to meet the national integrated and climatic plan change. Means they need to incentivize investment now in that front if we would like to electrify. So they talk about the elimination of delays on recognition of investment. We are having problems on that one. The fact we have in the court several demands or several litigation because of no recognition of certain investment already done in the past. That is recommended not to happen. And last one, they are talking about rate. We have already to cover full cost recovery to be attractive, for attract this hundreds of billion euros the Europe need already in investment in the grid. However, this draft proposal, I think, in my opinion, is providing a clear negative signal to the market, signaling the side of reducing the maintenance cost, so the recognition of the cost of maintenance of the current network infrastructure, and not incentivizing the investment in new assets. I think that is my reading of what they have already done. And I think we will make our answer and our response to the consultation in August, and I think we expect then the things will move on the right direction. Nevertheless, as you saw, the size of our regulated business in Spain is quite small compared with the rest of another countries. It's, by 2030 is less than 10% of our total regulatory asset base, so which I think is important, but I think is not crucial for us.
Next is, what's your take on the draft proposal, draft determination on the Rio T3 framework elaborated by Ofgem?
So I think opposed to the Spanish one, I think our view to that one is positive. It recognizes the need of significant more investment in electricity infrastructure. It's aligned with the UK government energy and industrial strategy, which position electrification as the key driver of the economic growth, which was reflected in the industrial strategy of the government. The government is also underlining the relevance of creating a stable and attractive framework to enable private investment. So, and that is what is reflected. And I think it's that way. I think that there are determination, including in our case, this 14 billion new investment in transmission up to 2031, on top of the 8 to 10 billion that will be invested in the distribution in the next 5 years, so which part of them correspond to ED2, and another one we expect already will be in the ED3 once ED2 is finished in 2028. The draft also introduced improvement in the financial parameters to make that more financeable. But I think we are now in talks with OGEM because for looking for some details and to improve some of those parameters. I think globally we are positive, but I think there are things that we are already negotiating to improve certain things. Also, I have to say about the British government, the coherence of the British government, the British regulation, is I mentioned to you as one of your questions in the last conference, you asked about the zonal pricing. I was saying that is going to happen. I can confirm that the government has already confirmed my advice that is going not to happen and is not to proceed with this zonal pricing.
Next is related to the East Anglia 3. Can you please outline what is the impact booked in the different lines in the P&L from of the sale of East Anglia 3?
Pepe, you can explain that one?
Yeah, well, as I have mentioned in other income, which is in the expense part, so over the EBITDA, we have a minus 81 million euros negative impact, and we have an around 250 million positive impact on the derivatives part. So in this first half, the impact is plus 170 million. The only thing is that in the third quarter we will have to book another negative impact, precisely in net operating expenses of around 60 million euros. You know, that will reduce at the end of the third quarter the total positive impact to around 100 million before taxes, which is around 75 million after taxes. So as of the first half, we are booking 170 million before taxes, and on the third quarter we will add a negative impact of around 60 million, and that will give us a net profit for the whole transaction of slightly over 100 million before taxes and around 75 million after taxes by the end of the third quarter.
Next is related to the effects or possible effects of the yesterday's rejection of the Spanish Parliament of the anti-blackout decree.
So, as always, we respect the decision of the Parliament. So I'm going to enter into the local debate. We have enough debates and we are going to carry the debate. I think, as far as I know, some of the measures included has already a sense in the area of increasing security of supply of the system, reduction of the bottlenecks that are creating latent demand which is not covered, especially for industry, and we've been already for years claiming for that one, and promoting the new electricity demand, so with a level playing field. But I think I'm sure that I heard as well that the position is thinking to present just a law for covering all these things. So, which I think, I don't know if it has to be a royal decree of a law. Sorry, it was off. I will come back again. So I said then I respect already the decision of the Parliament, and I don't like to enter into the local debate. So I was saying that there are some measures included we has already sense, such as security of supply in the system, reduction of the potential bottlenecks, covering the latent demand we cannot be covered today, especially in the industry. And one thing which is very important is promoting the growth in electricity demand with a level playing field. But I think what I heard is that the opposition is presenting or preparing just a law covering all these things and others, I don't know which ones, and I think we will see what is the point. So, but I don't like to come into the parliamentary debate. I don't know some reason for that one. And I think the important thing is to solve the problem that we have in the system. And I think those ones, they have to look what is the best way for solving those things.
The last question received is one related to the press news of today about the possible plan of Iberdrola to sell the remaining assets in Mexico. Can you comment on this?
I don't comment on rumors, no idea.
We have several questions about the next Capital Markets Day to be held on September the 24th. So obviously we will drive all these questions to this Capital Markets Day. So now, please let me now give the floor to Mr. Galán to conclude this event.
So thank you very much for the participation in this call. So as always, investor relation team will be available for making answer whatever questions you would like to pass. So I think I would like as well to use this opportunity to thanks to the teams we has already worked in the transaction, which I think is becoming already a success. And Pepe and your team, thank you very much, because you have already done a great job in that a few hours when you prepare all those things. Thank you very much, all of you, and I hope you enjoy already with this new opportunity that we have already in this moment. Thank you very much for your attention, and if you have not seen the opportunity, I wish you a very good summer holidays. Rest a bit and see you in September. Thank you.